we've talked a lot about the bands, and we've talked about pattern recognition. We've talked about some of the indicators. Now we're going to get to some of the practical applications. What do we actually see out there? We've looked at what some of the things that one might look for when patterns form in real time. W bottoms, head and shoulders tops, throwback entries. The question I get asked more often than any other question is, or actually I should say the statement I hear more often than any other statement goes like this: "You idiot." That's how it starts. "You idiot." Time and time again, a stock will just walk up your upper band, issuing a million sell signals while it's going to the moon. Right. Okay? Or now I get the other one. "You ding-dong." Time and time, you know, a stock will walk down the lower band, issuing a million buy signals as it goes down to zero. Shame on you. Well, shame on me. Correct. A tag of the upper band is not a sell. A tag of the lower band is not a buy. More is needed for a reversal signal. Price patterns, indicator facts, and volume data are some of the elements that can be combined into the issuance of a sell signal based on a tag of the upper band or a buy signal based on a tag of the lower band. But there is nothing in and of itself about a tag of the band that tells you anything other than prices are either high or prices are low. Does anyone have any questions about what I just said?
Been there.
Okay? It's really, really important. Prices can and do take extended walks up and down the bands. These are exploitable opportunities to participate in the walk, not opportunities to fade the walk 100 times. I'm just going to go back over this again because this is elemental to your success using these techniques. A tag of the upper band is not a sell signal. A tag of the lower band is not a buy signal. Okay. Prices can and do walk up the upper band. Sometimes for very long and prolonged periods. Here's a W bottom formed by the S&P 500 in the fall of 1998. Here is our initial liftoff, and here is our first sign of strength, followed by a second sign of strength. Here is the band expansion that constitutes the rocket motor going off. All right? And then here is a prolonged walk up the upper band. One pullback, failed to tag the lower band. More, again, a consolidation. More, a consolidation. And yet some more. This type of activity is to be expected. It is not an anomaly. This happens during virtually every major sustained uptrend and downtrend that lasts from, say, intermediate term to long term, in terms of maybe that lasts, more than 30 bars, shall we say. Often they will be punctuated by consolidations. Often you will see the occasional pullback to the lower band. Right? prices can and do and will walk up the upper band. Prices can and do and will walk down the lower band and walk up the upper band. This is Vishay again. This time I wrote the oops in. This is the sell signal, not this. So we march up the upper band. There's a pullback here. We march up the upper band, pullback, again, new high, pullback, new high, pullback, no new high, one. It's a little hard to count because it's more than 3 pushes to a high, but let's just call this 1, 2, and 3. Outside the band, can't get outside the band. Pull all the way back to the lower band, fail to get to the upper band. The failure to achieve the upper band is the sell signal, not the tag of the upper band. Oops. Oops is important. It happens all the time. After you've had to walk up the upper band, if you fail to achieve the upper band, that's a potential oops. If you then accelerate to the downside, that's confirmation. When we look at volume indicators, what you'll see, and you'll see a chart very similar to this one, you'll see that the volume indicator ran strongly positive right into this area, transitioned to negative, and then ran strongly negative for the balance of the chart. And what I've done actually in a chart that you'll see later on is I've used a volume oscillator, intraday intensity, and I actually drew a line, just a straight line, underneath the zero line on this side, and then over here, from here on, I drew a line above the zero line. It was never touched on this side and never touched on that side. So you'd seen a basic change, a gear shift in the market mechanism that occurred right in here. And I would actually say that it occurred right here. When it tagged the upper band, then came slicing down. Right. This was where it broke. But this is the signal. Right. So it's just incredibly important that you take that piece of information home. Prices can and do and will walk the bands. It's to be expected. It is not an anomaly. Here we go. Here's intraday intensity, Texas Instruments. It's a different picture, but it's the same idea. Uptrend in the indicator, downtrend in the indicator. The inflection point is right there.
What's that indicator again?
This happens to be intraday intensity. It's a volume indicator that is based on where we close in the day's range. And we'll give the derivation of it a little bit later. But this is the typical picture that you will see. Steady progress from an indicator with steady progress in price. Transition to a negative environment and the indicator turns down and starts making steady progress to the downside. So any of these rallies in here can be regarded as opportunities to sell the stock. Here you have tags of the upper band with a positive indicator, and here we have tags of the upper band with a negative indicator. That's the difference. One is a confirmed tag of the band, The other is an unconfirmed tag of the band. One, you have strength confirming price action, and the other, you have weakness non-confirming positive price action. That's what makes the difference between a tag of the band being a sell signal or a tag of the band being a buy signal. Yes?
On the three-day, three push, three pushes up,
Three pushes to a high.
three pushes to a high. Is there a minimum time frame that you would assign to that?
No, there's no minimum time frame that I know of, the three pushes to a high. I just like the pattern to be discrete so that, you know, they're nicely separated by and clear. And I like the earlier pushes to be able to get outside of the upper band and the last push to fail to get outside the upper band. That's the best diagnosis. Often it's not as pretty as you would like it to be, but that's the perfect diagnosis. The first push strongly outside the upper band, the second push just barely outside the upper band, the third push maybe not even able to touch the upper band. That would be the ideal picture. Here's the indicator that I told you about before. This is simply a short-term version of this indicator. This is intraday intensity in its open form. This is closed form, a 21-day version of intraday intensity. Here's the pivot point right here. Right? The pattern of the indicator is broken by this decline. We spent all this period above the line. We spend all this period below the line. It's not perfect, of course. You're going to have, you know, a couple of ticks in the opposite direction, but the idea is there. We're beneath the line in negative territory here, and we're above the line in positive territory here. I like to color this green above the line and red beneath the line to remind me how important that this stuff is. So let's just walk through a bit of the chart here. Tag of the upper band, positive indicator. Tag of the upper band, positive indicator. Tag of the upper band, neutral indicator. Maybe 1 day's worth of indicator here, negative, so that you'd be on alert, but then followed by another tag with a positive indicator. Tag, positive indicator. Tag, positive indicator. Tag, positive indicator. Tag, positive indicator. Failed tag, indicator still positive. Tag, negative indicator. That's how you diagnose a walk up the bands. Now, you know, it's the same old drill. I don't know how to get you out up here, but I can get you out over here. Maybe here, maybe here, depending on what you're looking at. Here, failure to get to the upper band and an impulse move to the downside, you might have said, well, yeah, but the indicator's still positive. Yeah, I'm not so anxious to take that. Here, tag of the upper band, indicator's negative. There's no excuse anymore. Right? That's about as clear a warning as you might see. Did you have a question?
Well, you just answered it.
Oh, well.
You don't have that on this graph you do, but if you were sitting there right where that arrow is.
Let's try to, I don't know how to shutter this thing so that we can't see forward, but let's just try to ignore it for a moment. You come down here, right, and you break this, and the indicator turns down, but you're right, it might be just you know, just a blip, just like this one was over here, all right? It might be, so you wait a little bit, and then you rally back and you start trading sideways here, You spend almost 10 days trading sideways, and the indicator's getting worse and worse and worse and worse. Now you go up and tag the upper band, and the indicator's solidly in negative territory. It's not a blip anymore. But I understand that this decision is much harder to make than this decision. You know? But then if you were long this thing, you know, from back here, what's wrong with being scared out? You know, maybe there was another move here, but, you know.
But then it rallied and it went a little slightly positive. Would you, let's say you decided to short in there, would you worry?
You say it went rallied and it slightly positive. Look at the rally. The first time you get outside of the upper band, that's on a negative indicator, right? The indicator does turn positive during this little consolidation here on 1, 2, 3, 4 days, but the next rally isn't able to take out the upper band, and then you get a sign of weakness immediately thereafter. So yeah, there might have been a period, a day or two in there in which you could have been fooled, but you would have had your head turned back around the other direction pretty quickly by that sign of weakness. Remember, in a stock, the impulse moves come in the direction of the trend. So when you're starting to see impulse moves to the downside, here's the first one, and here's another one, here's another one, here's another one, here's another one. When you're starting to see those impulses, the big days come in on the downside, that's pretty damning evidence. And I think you should pay attention to that. Yes, sir? You know, it's a matter of taste, really. Open form versus closed form. Some people are really enamored of this form because they can plot it in the same clip as price. And they plot it right there alongside price, and to them it's really intuitive and it makes sense. And somehow that oscillator down there, they just don't trust it. You know? So it's a matter of taste. The reason I coupled the charts side to side, look where this reversed. Right in this box is where it reversed. The high was made here, and this is where this guy reversed. So, and look over here. You know, the peak was here, so actually you got a little bit more information from the open form than you did from, than you do from the closed form. But nonetheless, when it's really important time to make the decision, they're both saying the same thing. And that's, to me, the key. It's a matter of taste is all I can say. Okay. Often during a primary move, the average will act as support, especially if you've done a good job of specifying the average. So, here you have a perfect picture of it. We transition from a squeeze in a head fake. We'll talk about that later. I mean, don't stop me now, but we'll get there pretty quick. But here we transition from a squeeze with a head fake that results in a big uptrend. And here we go, 1, 2, 3, 4, 5, 6, 7 tests of support at or above the moving average. That's typical of a walk up the upper band, is that the average then becomes support. Sometimes it's penetrated a little bit. Sometimes the idea is that in general the average is rising and provides support. It's a kind of broad guideline. The average is broken here, suggesting an end of the trend. It goes flat, and then, well, I wish we had a few more bars, but I can tell you, anybody know what the price of Archer Daniels is these days? I bet you it isn't far different from where it is here. I don't think that this rallied any more than this, but this is clearly a warning right here. And the first thing that I would do is check my indicators and see whether they hadn't turned negative during this period, and this wasn't an unconfirmed tag of the upper band. But the point of this slide is this period, when you 1, 2, 3, 4, 5, 6 occasions we get outside of the upper band, all during the period the average is providing support and rising, turns flat here, volatility turns down. This seems to me to be the end of the trend, and I bet you it was. Now, I am not an Elliott wave fan in any way whatsoever, for the simple reason that Elliott wave is applied in our business as a religion rather than a tool. R.N. Elliott had some really justly brilliant observations about basic psychology and how that psychology expressed itself in the price structure. He observed that, you know, we expand in this type of mode. You see 3 pushes to a high here. Clearly, he understood that. He understood a lot of what goes on. You can, as far as I'm concerned, you can deploy some of this Elliott wave methodology with some success within the environment of bands. But you shouldn't expect it to be the be-all and end-all that it's typically sold as being. When it's working, when you see these types of patterns within an uptrend, when you see 3 legs up and then a little ABC correction, and then it goes right back to being a positive trend, it's useful background information to have, kind of like what the monetary environment is or whether the company's, you know, doing well in terms of growth and such. So think of it as an added piece of information that sometimes you can use. For instance, you see the signature in here where you come up 1, 2, 3, 4, 5, and then you see your little A, B, C correction. So you see the basic psychology that Elliott was talking about being traced out. I think it's probably more important to focus on the development of the price structure itself over time and focus less on these kind of internal structure ideas. Keep them in the background as some additional methodology you can use to confirm your analysis, but don't let them rule you.
John, this is a delay, but ADM is about 13.2 right now.
Yes, well, now, you know, there's a stock, for as long as I've been in this business, I have heard analysts tout ADM. They always had the next best thing. They had soybeans, they had ethanol, they had, you know, lysine, they had everything that was needed for the next best thing in agriculture and science. But you know what? The stock has never gone anywhere. I mean, I was talking the other day, and this is probably very cogent at this stage of the game. I was talking the other day to a columnist from CBS Market Watch, and they were doing a piece on Apple. And they were kind of shocked when I asserted that Apple wasn't a growth stock. And I said, well, it's at the same price it was in 1987. So by definition, it's not a growth stock. Yet, and Archer Daniels is the same thing. It's been a bullish story that analysts have been telling for 100 years. Apple's been a bullish story that analysts have been telling for 100 years. And the same way, there are bearish stories out there that have been told for 100 years. I remember there was a huge tirade about shorting Cigna. you know, that went around the street for years about how their books were cooked and this, or that. None of it turned out to be true, right? It's very important to separate the opinion from the fact. Technical analysis tells you about the stock. Fundamental analysis tell you about the company. You know how to tell the difference between a technician and a fundamental analyst? A fundamental analyst thinks that he's right. A technician thinks that the market's right. And that's the divide. A fundamental analyst comes up with a set of projections for the stock that they think are right. And if the stock is trading cheaper than where they think it would be, they think that their analysis is right and you should buy the stock. And if the stock is trading way above their analysis, then they think that their analysis is right and you should sell the stock. So they fundamentally believe that their analysis, their opinion, is correct. The technician fundamentally believes that the market is correct, that the chart is correct. And I just ask you this one question. Which has a greater impact on your bottom line? Price action. So if in doubt, go with price action. If they're telling you a wonderful bullish story, but the stock's not going up, by all means, listen to the story, but don't buy the stock. Even more damning, if they're telling you, you know, a horrid story about the stock, but it's making new highs day after day after day, my suggestion is that you probably ought not to be short. I remember there's a very famous fundamental analyst in our business. He is a hedge fund advisor. I'll spare him his name. And he argued about Qualcomm. Every tick from 10 to 200. Now, he may ultimately prove to be right. But do you have any idea what kind of damage that would have done to your portfolio? Being short Qualcomm from 10 to 200? Right? And he pounded the table every tick of the way up. And I kept on telling him, I talked to him pretty often. I say, you know, it's on the new highs list. He say, yeah, but you know, their books are cooked. It's on the new highs list. Yeah, but the deal with China is going to fall through. It's on the new highs list. Yeah, but they're not going to be able to license that technology. It's on the new highs list. Yeah, but TDMA is better than CDMA. On the new highs list. Yeah, but the management's corrupt. It's on the new highs list. Yeah, but they're not going to make their numbers. It's so anyway. He didn't bankrupt me, but I don't think he's doing very well himself. So, address the issues of bandwidth for a couple of minutes. We'll have here a picture of IBM and a picture of the kinds of swings that you can see in bandwidth. Here we go from a bandwidth of roughly 10 to a bandwidth of 40 and back to a bandwidth of roughly 10 in a very short time. The obvious thing that's going on here is a capitulation low. I mean, they're thrashing the stock into the low, and we're seeing a huge spike in volatility as the primary low is being made. That's the main thing that goes on here. And then we get the retest somewhat later at lower levels of volatility, and that's really what we would expect to see. But note again how variable volatility is here and how much it can change in how short an amount of time. Because this is the key to the squeeze. And the squeeze is perhaps the most popular Bollinger Band technique. and I think rightly so. I don't know that it should be isolated as better or worse than any of the other applications, but it's a great application. It's a vibrant application, one that is incredibly useful, and I think you will find not only profitable to trade, but for me, the squeeze is actually fun. So here's the basis of the squeeze. Volatility is cyclical. High volatility begets low volatility. Low volatility begets high volatility. Volatility cycles are not usually regular in the time domain. That is, don't look for a low in volatility every 33 days. Don't look for a high in volatility every 22 days. And they're not regular in terms of amplitude. Don't look for, highs near 50 and lows near 10. The real key is that high volatility is a forecast for low volatility, and low volatility is a forecast for high volatility. Here's another example with remember we took a look at the 19-day volatility in the bond market? That chart was using interest rates. Here's a chart using the actual T-bond futures, the price of the T-bond futures. And again, you can see that 19-day cycle ticking through here. Here's one. Let's see. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months, 250 days. Somebody has a calculator handy? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 volatility lows in that 250 months. How many days on average? 13. So 13?
27, 250 divided by 19?
9.
Oh,
9, I'm sorry. 27. Okay. So this gentleman before, I forget who it was, but somebody over here asked about whether we might not be seeing a structural change in the volatility of the bond market because of the change in the financing mechanism, going from a deficit to a surplus, and so on and so forth. So, and this would seem to argue that that may indeed be the case, because this regular 19-day volatility cycle that we've known to expect has started changing here. We are running an average of 27 days in this particular year period. So maybe things are changing, but what isn't changing is that low volatility begets high volatility, and high volatility begets low volatility. That remains constant, and that is the basic idea behind the squeeze. Here's a perfect example of the squeeze. PPL Corp. I have about 150 days worth of data here. Volatility gets very narrow here. We plot it with bandwidth. You see we get down to about 5%. That's the upper band minus the lower band divided by the middle band. So the whole bandwidth is 5% as a function of the middle band. And then you get a giant expansion from there. Volatility goes from 5% to 40%. And remember our rule about this lower band turning up? Where does it turn up? Right here. Where does this first trend end and the consolidation period begin? So that leg is over when that lower band turns up. And you'll see that coming out of squeeze every time. Our definition of a squeeze is when volatility drops to the lowest low it has been in the past 6 months. Occasionally, you will see prices simply stall after a squeeze. Here's a squeeze right here. and prices simply go nowhere. Just dribble further, and then you get a re-squeeze over here. You'll see that maybe, I don't know, 1 in 15 times, 1 in 10 times. But most times when you get a squeeze of this dimension, you will get a sharp expansion in volatility very soon thereafter. And since we're going to wait to trade when prices start moving in our direction, we're really not going to enter the trade until in here. I would say that in the stock market, roughly 2/3 of squeezes end up in what's called a head fake. So here's a squeeze, come down, make the lowest low, we'll break to the downside, immediately reverse back up, and get a huge move to the upside. Again, the leg ends when the lower band turns up, go into consolidation, end up a little bit higher. So we'll have the two possibilities. Either we break directly in the direction of the trend, as we did here, or we break and then immediately reverse. Now,
2 out of 3 times it's the second alternative.
it seems like about 2/3. I've never counted, but it seems like there are more head fakes than not. So this is my strategy to deal with this. You get a squeeze, and you get that first big day down, like you have here. Put on 1/2 position in the direction of the trade. If it goes, it just goes, then you got a trade, but you've only got a half position. It's better than a poke in the eye with a sharp stick. It'll be a nice profitable trade, but it'll be a trade at 1/2 position. You may be able to find somewhere along the way to add the other half position, but I don't have a rule for that. If you get a reversal day like this, you punch out the lower band from outside of the lower band. If you get a big, strong reversal day and a sign of strength, then reverse to a full position immediately. Do not wait. Do not pass go. Reverse and go. And participate. So, in the case of PPL, we're going to end up with a half position here. And maybe during this consolidation you'll put on the other half position. Maybe you won't. Who knows? But you're going to end up with a profitable trade. Here, in the case of Adobe, the initial break is to the downside. You reverse to a full position. You got a small loss here. You probably entered short here, and you probably covered here. So it looks like you have about a 3-point loss on your short if you got the worst exit possible, which was at the very high of this day. If you were tricky, maybe you got out with 2 points, but let's assume the worst. So you got -3 points on a half position. You then go, and let's assume that you don't get out until, oh, let's be really mean, and let's say you get out there, right? I mean, let's assume that you really, you don't see any of this coming, and that, you see a sign of weakness and decide to get out. So you enter here, and let's assume that you get the worst possible fill on your short you can right at the close here, and you reverse here. So you tagged for 3 points at a half a position. That's 1.5 point loss based on a full position. You then get a big run, and you don't get out, but you get out at the worst possible time on the bottom of this big sign of weakness day. So you captured, let's just call it 7 points. It looks more like 8, but let's call it 7 points at a full position. So it's a 1.5 minus 7, 5.5 points.
Where was your original entry point?
Let's assume that it's right at the bottom of the breakout day. Let's assume that you get the worst possible fill that you possibly could get. You short it on the close of the breakout day, and you cover on the close of the sign of strength day, so that you have the worst possible circumstance. So we're talking about 1.5 versus 7. It's a great ratio. You can have a lot of breakage and walk away. Still profitable. That's what we're looking for. We're looking to have our winners be bigger than our losers and to have more winners than losers. Remember the two dimensions that we wanted to exploit. So taking a half position here, it works out okay if it just cascades down. It's a nice trade. It's not as much money as you might have made, and you might find a place to go to a full position, or you might not. If it reverses on you, then you're styling. You're going to really make some nice money. Yeah.
Did you put on the full position after you covered your short on the half position?
Correct. Correct. So let's assume in numbers. Let's assume a full position for you on a $30 stock is 200 shares. That's your position size. You all must have a position size. When you buy something, how much of it do you buy? 2% of your portfolio, 5%, 10%. You have some position size that you trade. So let's assume that on a $30 stock, your position size is 200 shares. So here, we shorted 100 shares at the worst possible place on the breakout day at the low. We covered that 100 shares and bought 200 at the worst possible day on the close of the sign of strength day.
To go long.
To go long. So we're, in other words, when you call up the broker the first time, you say, sell me 100 Adobe short at the market. You all use market orders, right? You all use market orders? You all interested in getting filled? Sell me 100 shares Adobe short market. Ring. Great. We sold you 100 shares Adobe short of the market on the low of the day. Thank you. Next, 2 days later, buy me 100 shares Adobe market to cover short. Buy me 200 shares Adobe market, go long. Clunk. Bring. Fine. We bought you 200 Adobe on the high of the day, or 300 Adobe on the high of the day. Thank you. Why use market orders? Because you get filled. It may not be the best fill on the planet, but it is a fill. And if your trading desk doesn't fill you, fire them. Once you've made a decision, you don't want to scrap your decision based on execution. The guys in my office will tell you, I know one kind of order. I pick it up, I say, buy N shares at the market, and I hang the phone up, and I wait for my fill. If you have a halfway decent trading desk, you can use a different order. If you trust your trading desk a little bit, you have some sign that there is some intelligence or trading savvy available on the desk, you can say, buy me N shares, market not held. And that gives them room to try to get you the best fill instead of just whatever fill they can get in the market at that second. Once I've made a decision, I want the position. The way to get the position is to use a market order. A couple of years ago, I had a conniption because I chased a stock around all day, got about 15 or 20% of what I needed, and the next day it went to the moon. And there I was. I needed about 6,000 or 7,000 shares, and I had maybe 450 shares or something. Well, what am I going to do with 450 shares? It just doesn't make it just not meaningful. In fact, it's a problem, right? Because I don't have enough shares to go around. So if there's a squeeze, then there's the spread. Squeeze, spread. Does anybody have a better name for this? I love the name the squeeze. That to me conveys exactly what's going on. But the spread, I don't know. The bulge, I don't know. If there's a squeeze, there's a bulge. And we've talked about this before. You get a bulge after a big primary move where volatility is expanded dramatically. When the band on the opposite direction, the lower band for an up move, the upper band for a down move, turns back and moves in the direction of the trend, that leg is over. It doesn't necessarily mean the trend is over, but that leg is over, and there's most likely either going to be a pullback or a consolidation. So the spread marks the end of a trend. Well, it really should say the end of a leg and or the end of a trend. Sometimes it will be the end of the trend, but often it's just the end of that leg up. And as I showed you in a couple of the other charts, you'll get 3 or 4 of them in a big move. Here's another head fake. Let's again do the scenario. Let's just guess and see how much our system would have helped or hurt us here. Okay, we're going to sell short on the day we break out. Here's our squeeze. Here's the day we break out. So let's assume we get the worst possible fill again. Looks like 21 to me. And then we reverse 2 days later. Big move in. We sold short here, so we're short at the low, a half a position. It's a $20 stock. Let's assume our half position is 400 shares. We're short at the low, a half position. We get back inside the band, and we experience an immediate sign of strength. So what do? We pick up the phone. We buy our 200 shares back because our full position size is 400. So we sold short 200 shares. We buy back our 200 shares and 400 more. So we reversed from being short a half position to being long a full position. And let's assume that that's a 2-point loss there. Does that seem reasonable? Let's assume that's a 2-point loss. That loss is covered the next day. And, you pick a point on this chart where you get out and you do the math for yourselves. Maybe you get out here, maybe here, maybe here, maybe you wait for this day to be broken here. That's probably where I would have gotten out. Maybe you're a hero. Maybe you get out here. I can't imagine it, but So, almost certainly you would have been shaken out here. But, you well may have been you may have been bored to death here and decided to exit. So if you exited here up in the 24 area, let's assume 21. So you gained net 2 points on 400 shares. Fair enough? Is that all? But then, yeah, so. Here's another example. You squeeze. You break to the downside. We'll do our same deal, half position, reverse back in. So we're back in here with a full position. And what do we get? We get a further squeeze. The bands actually get tighter. We go sideways for 5 or 6 days, and the bands actually get tighter. And then it takes off. Let's assume that we weren't fooled, that we weren't fooled by this, that we just ignored that. Then what happens? Well, let's look at the first case. We're fooled by this day. So we have a small loss here, maybe 2 points on a half position, and we're long a half position, a full position through here, and we participate, let's just say the first leg up, maybe about 6 points worth. Let's assume we're not fooled here, and we wait for this squeeze instead of this one. Then we're long a half position here, and so we have our 6 points on a half position. Do you understand what's working here? What's working here is not so much our analysis. What we've developed is a clever set of decision criteria that are based on the squeeze itself. And, you know, this gentleman here is from Montreal. He trades in very short-term sense. He likes these places where they squeeze in. So this stuff is, you know, because he's looking to trade volatility. Well, where do you find volatility? You find volatility after there's been a lack of volatility. So he's probably going to do this on 5-minute bars or 10-minute bars or some real short-term bar, and he's going to find these squeezes during the day, and then, you know, maybe he'll play it this way, maybe he'll devise another strategy to do it. But what's operating here, right? This is not our intellect, right? This is not how bright we are or how cool a trader we are, right? What's operating here is a very robust set of decision rules that's taking advantage of an anomaly in the marketplace called a squeeze to exploit an opportunity. Right? If you examine technical analysis time and time and time again, you will find that it is not the tools that make the difference. It's the decision rules. All right? It's not the VIX that makes the difference. It's the set of rules that you employ to trade the VIX. It's the decision criteria that is all important. You can use relatively crummy tools, and if you have good enough decision criteria, then you can come out on the positive side of the equation.
John, you do this in intraday stuff?
Yes.
And if you do...
You absolutely can do this on intraday stuff.
So how many periods are you talking about on the low? I mean, you don't have 6 months with obviously in intraday.
Well, 6 months, it would be 125 days.
125 periods.
So maybe 125 periods. But maybe you can find out what that number is for that stock. You know, maybe you can, or the commodity. Maybe you can find out that a squeeze is any bandwidth below 5% or 2% or 1%, whatever it would be for that thing. Maybe you can look back and find out. One of the problems is patching across the gap. You know, from the close to the next day's open, right? A lot of people just butt those bars together, but you know, often there's a price discrepancy because the price formation mechanism continues over the night. So you'll open higher or lower. So even if you patch the bars so that you butt the close up against the next day's opening, and maybe even include a piece of the night session or whatever, there are going to be some discontinuities. So maybe for that type of approach, the best thing to do is just identify what level represents low volatility for that commodity and look for those levels. And try not to get fancy about the exact look-back period. Just go back and look at a ton of charts and find out what that level is, and then keep that level in mind. And then when you see that level, if it's shaping up like a nice squeeze and you have an opportunity, trade it. Another squeeze, an example of just where it just breaks away. Here's you're short this day, and it just breaks away. Wango. And I don't see where you get, how you get into a full position here. You just enjoy the fall at a half position and take the money in, buy that nicer bottle of wine at dinner. That's what I do. Yet another example. I did this one because it's really a beautiful example of a squeeze accompanied by one of those impulse moves. Here's your squeeze in here. You bolt to the upside. You probably, well, let's assume you entered on this day. You got a nice run. You got 5 points under your belt almost immediately. You had an impulse, and then look what happens. Very painful. You get back to where you entered almost. You probably only have a point left here. But what did you have? An impulse move. What does that tell you? There's more to come. So you probably can live through this to gain some of this. Well, add on. That's a topic that I don't touch in this seminar, but it's easy to construct some add-on rules for these moves out of squeezes. You add on to every consolidation, and so it's very easy to do that. I myself am only in favor of adding on very early. Some people will continue pyramiding as they go along. Go 1 contract, 2 contracts, 4 contracts, 8 contracts, that kind of thing. I think you get killed that way. But I'm all for adding on in the early going. When things start to go your way, especially if you find a neat little place where you get a little bit of consolidation with no real deterioration, the indicators just pull back a little bit toward neutral and such, it's a great place to add on, but do it early. If you're going to add on, early is the name of the game. You don't want to be adding on late in a move, levering up against a reversal against you. It'll wipe out all the money you made, all the work you've done. I did this because you'll see this every once in a while, and it's really kind of a joyous thing. You come along here, you squeeze, you break down, you're short here, and you go through here and you re-squeeze. It's a 1-2. It's not there must be some jingle. My daughter would know it. But this is a perfect example of a squeeze. You got a nice little trade here. You got maybe 8 points under your belt as you're coming in here, and you get a re-squeeze. So add. This is a great place to add. You're profitable. It's early in the process, and then you get this collapse. Yes, sir.
Does that violate the fact that the squeeze happened in less than 6 months?
It looks to me like this is a new low.
Yeah. It's even lower than the other one.
Yeah.
Okay.
So it's a legal squeeze no matter what.
Good answer.
You think I've looked at these charts before?
I know someone mentioned earlier something about candlesticks, and you alluded that, yes, that is a whole nother program. How important are...
One that I don't teach.
Not yet.
Oh.
But how important are
Oh.
candlesticks to Bollinger Bands? In addition to, just beside the simplicity of looking at negative, positive per day.
The only reason I use candlesticks is because I think they give you a clearer view of what's going on. They're not that important. You can use bars. I guess you could use line charts if you really felt like it.
No, I didn't know because some people can read the bars, so to speak, the candlesticks.
Oh, if the candlesticks disturb you, don't use them.
No, I'm not saying it. I'm asking how important are they? I mean, are you reading them besides the Bollinger Band? Let's just say you have that where that second consolidation.
Are we going to be in for a chapter of Confessions of a Secret Candlestick Reader? Yes, I do.
That's what my question was. I mean, because
Absolutely.
to me they mean something else other than just.
I know a relatively small number, maybe 15 or 20 candlestick patterns that I pried out of Shaky Shamuse's book and some of the other books that I looked at. Yes, I look at them all the time.
Okay. Oh, no, I'm just
And
curious.
I like them, and they help, and I think that it's, you know, if you can have a kind of sideline in this business, candlesticks are a wonderful sideline because they're a whole view into Japan and Japanese history. The nomenclature is all based on Japanese, you know, fiction and mythology, and it's wonderful. PPL Corp, we looked at this before in another context. Squeeze, breakout from the squeeze, big impulse move. Look, volatility goes from 5 to 40. Volatility turns down, the lower band turns up. It's the beginning of a consolidation. Again, you get another impulse move out of it. Volatility turns up, it turns down again, little hook up, and it's the end of that move. Always look at these opposing bands and always remember these big impulse moves. Very important in correctly diagnosing these pieces. Now, a little bit of coding. Here's how you code the squeeze in Metastock. Are you ready? Am I going to lose all of you? No? Okay. Let's start on the inside of the brackets. So, here's the first drill. Standard deviation. We're going to calculate the standard deviation of the close for 20 days. See that piece? Now, we're going to use this function called LLV bars. LLV bars tells you how long ago the lowest low in the past n days occurred. So we're going to ask for the lowest low value in bars for the past 125 days. If that's less than 7, then this statement is going to be true. It's going to evaluate to 1. If not, 0. So we're going to, what we're saying is standard deviation. If the lowest low in standard deviation in the past 6 months was within the past 7 days, then I'm true. This portion of the statement is true. Notice there's no apostrophe here. Semicolon, sorry. So the statement doesn't end there. It continues on to the next line. And if the close crosses the top band, Bollinger Band top, based on closes, 20 days, simple moving average, 2 standard deviations. So we're going to go long if the lowest low of the standard deviation the past 125 days was within the last 7 days, and we break out. If the close crosses above the upper band, And that's what this cross function means. The cross function tells the program if the close was less than the upper band yesterday and it's more than the upper band today, then this cross function returns true. So if it's true and it's true, then we're long. So you open up in Metastock, you click on the $, which is the systems box, and you copy this logic into the long entry box. And then this is exactly the same, but we've reversed these two arguments. So again, if the lowest low in standard deviation in the past 6 months was within the past 7 days, if we've had a squeeze within 7 days, and we'll cross the bottom band versus the close. So in this case, the close had to be above the bottom band and cross beneath it, then this will be true. And so you take this and copy it into the short entry. And Metastock will then find all squeezes for you on any stock you look at. Any questions?
And you can run this as a scan additionally, right? As an
Yes, you could plug this logic in as a scan if you wanted. I happen to write it in order to put it into the system, the $ guy, but you could run it in the scan, which is the set of binoculars. Yeah, you click on the set of binoculars and you say, click on New, and then enter this logic, and it'll go through and scan for you. So here, TradeStation code. This is a nice trick that I put in here because I've done it as an alert. So it'll signal on the right-hand side of the chart when this happens. If you have this, if you load this study into TradeStation, then when this happens, it'll signal you right on the chart. So buy alert. If the lowest bar of standard deviation within the past 125 days, this is going to return the number of days that it is to the lowest bar. So if the lowest bar was a month ago, this will return 20. If it was today, this will return 0. If it was yesterday, it will return 1. So if standard deviation fell to its lowest low yesterday, then this part will return 1. And so I say if the lowest bar is less than 7, so the squeeze happened within 7 days, and BB data crosses above upper BB. Now TradeStation's nice because you can just write those in like that and it goes and snaps the formulas out for you. Right? I have these written as functions. So I wrote BB data and upper BB and that stuff. I wrote them as functions, but they're the same. It's exactly the same code I showed you before. So if BB data crosses above the upper BB, then squeeze equals 0. I mean squeeze equals 1, else squeeze equals 0. Now I combine this all into one study rather than splitting it into two like I had done with the Metastock code. So I say sell alert if BB if the same criteria are met, but BB data crosses below the lower Bollinger Band, then squeeze equals -1, else squeeze equals 0. And this is a really important piece of the puzzle. I designed years ago when I worked with F&N with a brilliant engineer by the name of Gene Stratton. We came up with a set of 3-state logic for traders. It's 1 if we're long, 0 if we're flat, and -1 if we're short. So it's not the way normal logic works, 0 and 1. It's a logic that applied to trading. And so that's what you see at work here. When this whole thing runs, if there was a squeeze and breakout to the upside, it returns a 1. If there was a squeeze and breakout to the downside, it returns -1. Otherwise, it runs as 0. So you can plot this as an indicator, and you'll get a flat line, and then with a little blip to the upside when you have a squeeze and a breakout, and a little blip to the downside when you have a squeeze and a breakdown. So it's a very useful way of doing this. 0 for normal state, 1 for when you get a positive signal, -1 for when you get a negative signal. So you get a So you get a flat line, and you get a spike when you get a bisignal, or which one is which? Which is a stalactite and which is a stalagmite? Come on, somebody's got to know. Okay, a mite, a stalactite points down. So you get a stalactite when you get a breakdown, and you get a stalagmite when you break up. Did I get that right?
Yeah, just think T for top and M for bottom.
C for ceiling.
Oh, it's stalag and stalac, tight and mite. Our French speaker is familiar with these problems. Us poor English speakers, we don't have such complexities. So, yeah. So anyway, and that's a really, all these systems and stuff like that, they can all be programmed in that form. And that way you just put the system as an indicator in its own little clip, and then you can see all the signals plain as day, and it doesn't clutter up your chart, and you don't have all these bells and whistles and gongs and, you know, arrows and widgets and flying around. You just have a nice clean line with bisignals and cell signals and when you're flat. The squeeze example with parabolics, these are what we're going to get into tomorrow. Wells Wilder developed a stop and reverse system called parabolic. So here we have an example of how to manage a squeeze without the decision rules of a half position and a whole position. Here we go, a squeeze, you break down, you fire the parabolic up, and the parabolic is your exit, right? And what a parabolic is, it's a stop that resets only in the direction of the trend. So you notice that it only falls, right? So I got my signal right here. I started my parabolic immediately. I shorted, and as soon as my parabolic is crossed, I'm out. Normally, parabolic is presented, or SAR as it's called, stop and reverse, as a complete system where you stop and reverse. I'm breaking all the rules here. I'm taking the logic and I'm starting it at a spot that I choose. By the way, a really nice guy by the name of Robert Dedman wrote me the add-in for Metastock that does this. It lets you start a parabolic at any point on the chart and then run it from that point forward. Otherwise, none of the software will let you do it. But anyway, he wrote this really neat little tool. And that's what you see in action here. And here's another example of how powerful this technique can be. Here's a squeeze. We break down, and then we reverse back in. As soon as we reverse back in here, I go to my full position long. Right? In other words, here's my squeeze, occurs right here. We break down and I short it. Right? But immediately, we're outside of the band, 2, 3, on the third day, we get back in for a sign of strength, so I reverse to my long position and start a parabolic underneath my position. And you see it increments and just starts on incrementing in the direction of the trade. and it's relentless in its increment. The gentleman over there had quotes before, GDI. Can you get a quote for it? This chart is only a few days old.
How do you get,
So, what?
how do you get that indicator?
You can do it yourself. I'll show you how to do it. You can do it in a spreadsheet based on the logic in Wells Wilder's book. It's not too hard to do. You just don't do it the way he said. Well, no. He says that you start it immediately. You reverse. The moment it's triggered, you reverse to the other side, and you reverse, and you reverse, and you reverse. This, you don't do it that way. You just use it for this trade. So when you do your entry, you start it up and you run it till you exit, and you don't reverse. You just walk away and look for another setup. So I'm not using it as a system. I'm using it as an approach to set my stop for a trade that I entered in a completely different manner. So here's, sorry? 26.15, so it's still above the parabolic. It's still long. This trade is still ongoing. The parabolic, let's see, this chart's 2 days old, so it's trading up here. This parabolic's probably accelerated. It's probably about 25.5 right now. So this is an ongoing trade. You can track this trade next week because the parabolic is at full acceleration here. So the constant is 0.2, 0.02. No, the step is 0.2.
What's the exit point? Because the stop price actually crossed it.
Nope, didn't close.
Oh, it's got to close?
Got to close. Got to close. You can see that's a white candle, so that tells you that close was up at the high of that bar. You know, a parabolic, using a parabolic stop like this after a squeeze is like wearing a belt and suspenders. All right? So, you know, but it does have its price. It means you don't get the whole move, right? Because this reaction was big enough to take you out. So you're done. You have to go find another setup. There is no re-entry that I know of for this. You got a nice piece here, right? A nice big fat piece, but you didn't get it all, right? If you had done, if you had just gone seat of pants, maybe you would have gotten out, oh, I don't know, some other place. Okay, the other type of exit that we're going to talk about is a chandelier. I really like these chandelier exits. I think they're terrific. They're based on the average true range, and they work very much like a parabolic. Here's a squeeze with Donnelly. It occurs right here. We reverse back in here. It's a head fake. We reverse back in right here, and we start the parabolic underneath our entry day. All right. The parabolic marches north steadily, all right, and we get taken out here. So here, outside the lower band, reverse back in. It's a head fake after a squeeze. Run the stop. You get a very nice trade out of it. You lost, oh, let's be mean and say we lost a full point here. And then you gain on a half position, and then you gain 1, 2, 3, 3.5 points on a full position. So net 3 points on this little squeeze here. Is that right, or is that 4 points? 1, 2, 3. Yeah, 3 points. And one final example of a chandelier. Again, this is a simple entry. It's not a squeeze. You can use a chandelier in this regard to protect against the possibility of a head fake. You enter on this first strong down day, start the chandelier, stop above your entry point, and it cascades down. You make a low here, and then you're taken out on the first day that you cross above the chandelier.
Why is there not a squeeze?
Why is what not a squeeze?
At the top you said it's.
Oh, this is just not a head fake is what I meant to say. I meant to say not a head fake. It definitely is a squeeze. It,
You're half position there?
yeah, you're a half position through here. But, you know, maybe after you experiment with this, with the chandelier stop, you'll find that it's robust enough that you can employ a full position. You can change the decision rules based on the robustness of the chandelier stop. I'm only using the chandelier stop for a few months, so I'm still learning a great deal about it. And that, my friend, is way more than I intended on doing. I've kept you way too late.